Sweet. Well, let's get started. We're going to cut through some of these slides here, guys. So quick note from our Ironton Capital's attorney here. So we have this within every presentation that we do. Of course, this is a real estate trends webinar. It's completely non-biased. It's completely objective. There's no discussment of or offering of an investment opportunity. If you do see any statements in here that say like project, will, should, please understand those are all forward-looking statements. I will pass through this slide from there. Quick overview of the investment team at Ironton Capital. Lon Welsh, who's usually here on these calls, I think he might be sleeping in Austria right now.
Yeah, he is in Austria. Yeah, so I spoke to him earlier today. He's in Austria having the time of his life.
It's hard to keep track of him in the winter. I think he'll be in northern Italy after Austria. So, if you ever get emails at like 3 a.m, you'll know he's out of the country somewhere. But yeah, so he's obviously not here, but he's the founder of Ironton Capital, joined by Brent Geyer. He's our CEO at Ironton Capital. And then Richard Landry, he's our chief investment officer. So you can see the bullet point list of all their very impressive experience, cumulatively probably about 40 to 60 years of commercial real estate accounting and fund experience. So if you have any questions just about the team, feel free to reach out to us. We're always available. That being said, Joe, let's get into the presentation. What do you got for us?
Yeah. So as we get started, guys, a couple of really common questions that come up. Number one, yes, you will get an email after this presentation that will have a copy of the slide deck. We have 111 slides. We are not going to have enough time to go through each and every one of them. So we're going to pause at the key slides. So you will get a copy of that after the presentation is over. It'll be emailed out to you, and you can certainly go through it in depth. And number two, over on the right-hand side is a chat box. As we're looking at stuff, Nick and I will both be keeping an eye on that, and we love to make this interactive. So if you see something that you have another question on, or you want some more clarity on something, feel free to put those questions or comments in the chat. If you see something that you disagree with, sometimes that can be our best opportunity for learning. So feel free to put agreements, disagreements, questions, anything you want to get more clarification on, put it in the chat on the right-hand side. So here we are, first quarter of 2025, and we're officially halfway through the first quarter. And what you'll see as a summary is prices were up slightly in 23 and 24, and we're finally seeing buyers that are more likely to say, yes, I am ready to buy. And we're seeing more sellers agree, yes, now is the time to sell. And that's leading to inventory increasing, and it is not as much of a seller's market as it has been in the past. In fact, some neighborhoods are now a full buyer's market. What we're seeing is that rates have improved from 8%, which is where they were at in late 2023. But the primary challenge is affordability. And while everybody likes to blame interest rates, and I love to be the culprit on that, don't forget taxes have gone up, as well as the big culprit, homeowners insurance and homeowners association dues. So we're seeing kind of a 4 or 5 pronged approach that is challenging affordability right now. So throughout the rest of the year, we might see rates improve, maybe 1/4 to maybe 0.5%. But if you're expecting rates of 3%, 4%, 5%, that's probably not going to happen. And so our outlook is the first quarter home prices are going to be up slightly compared to last year. Condo prices are going to soften a little bit. We've actually seen some declines in condo prices. We've seen a big decline in the number of condo transactions. And that goes back to what we were speaking about earlier. Homeowners insurance and homeowners association dues are up quite a bit. And you see their home volume. So real estate agents on the call, there's going to be an opportunity for more transactions this year versus last year. However, condo volume is going to likely be down. So that's an opportunity. If you have investor buyers, they might be able to snag a handful of really good deals on condos as prices decrease a little bit. And as transaction count decreases a little bit on condos, there might be some opportunities there. If you're a first-time home buyer or working with a first-time home buyer, buy as soon as possible. All right. And then refi when you can. And the reason we talk about that is home prices are likely to continue to go up, and you can only negotiate on the price of the home one time when you buy it. So the price of the home today is likely to be the cheapest it's going to be for the foreseeable future. Now, I understand interest rates are high compared to the past years. But whenever interest rates go down, you can refinance. And if you happen to work with me, you can actually refinance for free with no closing costs. When interest rates do go down, you're going to see that there's going to be a flood of buyers coming into the market, and that's going to come in a lot faster than sellers coming to the market. What that's going to do is that's going to lead to competition and even faster increase in home prices. So if you're a first-time home buyer, you want to beat that wave and buy now and then refinance whenever interest rates go down. If you're a trade-up buyer and you've got an average to nice house, you want to buy now for the same reasons as a first-time home buyer. But really important, you want to make sure that your home is parade ready. I spoke a lot about this on a quarterly update call with Pine Financial the other day. If you have a home that has deferred maintenance, poor pictures, overpriced, it's going to sit for a long time, and it's going to make your seller and the real estate agent really frustrated. So if you're coaching clients that are ready to trade up to buy a new home, make sure that home they're selling is parade ready and priced appropriately. Now, if you've got an owner occupant who's going to sell and they're not buying, this might be an opportunity for these folks to wait. All right. We've got in here when prices drop, but that should say when rates drop. When interest rates go down, demand is going to increase faster than supply, and that seller's market power is going to increase. Now, if you're a trade-up buyer with a below average house, you probably want to wait for the same reasons. Subpar homes are not going to sell easily right now, and they're probably going to sell at a discount. However, if you have to sell a subpar home, right now is the best time to do it. In fact, Nick, I'll quiz you. We did a study a few years ago, and we studied all 365 days of the calendar year. Do you know what day is the best day to list your home if you want to sell above your listing price? Do you know what day in the year?
Oh, that's a tough quiz. I've got a 1 in 365 chance. February 28th.
That's right. You're really close. February 15th. The day after Valentine's Day, if you list your home, it will sell for the biggest premium compared to the list price as compared to any of the other 364 days of the year. So if you have a seller that has a below average home, we're already past February 15th, but only 3 days past, might be a good time to get it listed as buyers are starting to come into the market, because February 15th is really now the beginning of the spring selling season. Now, if you've got investor buyers, same thing, buy now and refinance later. And if you're trading up, you've got 1031 trade up buyers, buy now and refinance later. So Nick, anything to add on that slide? Any thoughts?
Yeah, I wanted to go back to you comment on we might see like a 50 basis point difference in rates from where they're at today. I think the overall sentiment for 2025, I think a lot of people were thinking, okay, we'll get through 2024, tough year in the real estate market. 2025 will be a lot better. But I think in reality, we're probably going to be pretty stagnant again. It sounds like the overall sentiment is we'll be between 6 and 7% on the 30-year mortgage. We've seen the 10-year treasury actually, since there was a change in administration, that actually went up nearly 120 basis points. It started to come back down. But there's a lot of risk in premium being priced in right now with the potential for tariff increases that have already happened and may jump up quite a bit again. Immigration changes that are going to overall affect the real estate market, especially from a construction standpoint. So if you were waiting, like Joe said, if you're waiting for rates to come back down into the 4s and 5s this year, I think you're going to have to, quote unquote, persist until 26. I'm sure there will be a slogan for 27 when we get to that point. But, I think we're at a point where we're going to be between 6 and 7%. And if you're looking to buy and you're trying to wait for interest rates to drop, you might be waiting a long time. And so I think this is going to be another year of persistently high interest rates, both in commercial and in residential. So,
yeah, I completely agree. And we've got some slides on that we'll touch on when we get to that section, but you're spot on. Waiting right now, I think, is a losing proposition if you're waiting for interest rates to go down. All right. So let's talk about some of those key questions. Your clients are likely asking you, when will mortgage rates come down? Well, economists expect and are predicting that rates will drop anywhere from 0.75 to 1.25. I disagree with this. Lon and I have studied this a lot, and certainly the folks at Goldman Sachs, the folks at the National Association of Realtors, the folks at the Mortgage Banker Association, the folks at Fannie Mae, Freddie Mac, I respect all of those people a lot, but I do respectfully disagree with them. I think we're going to see very small declines this year, potentially improvements of only 1/4 to 1/2%. And what will it take for prices to come down? So condos, as we touched on, you might see condos decreasing anywhere from 2 to 4% this year, and homes are going to be up 1 to 3%. And the average of the experts is appreciation of about 2.5%. Will I be able to find a home if I move? This is a great answer as compared to prior years. And the answer to that is yes. All right. Inventories are at the highest levels in the last 4 years. So buyers have a lot of choices right now. And if you're selling a home and then going to buy a new house, this is the prime time to do that. Now, will the housing market pick up next year? And I don't love that, the housing market, because that can be described as a lot of things. So I think really the question here, will transactions pick up next year? And I would say to that, yes, I agree. The experts think that we're going to see 15% increase in sales. Lon and I think we're going to be somewhere between 4 to 6% increase in sales. So if you did 10 transactions last year, just through the market, you might expect to do 11 transactions this year, unless you really get out there and start doing a lot of new work. So if you're a real estate agent, don't expect the market to save you. You really have to be out there hustling and doing your work. And my favorite question, is the market going to crash? We have a slide for this. The answer to that is very simply no. So unlike 2008, 2009, almost every single home has a ton of equity, and foreclosures are highly unlikely.
Yep. Now, we had a question here, Joe.
What
about if you were doing a seller carry on older homes?
So that's a really good question. Seller carry really knocks a lot of these stats out because you can offer really beneficial financing. Now if I'm doing a seller carry, I probably want 8, 10, maybe even 12%. But if you're trying to sell a property and you want to spread out those capital gains over a long period of time, seller carry is a great way to do that. And you could choose to offer really preferred financing. You might be able to offer a seller carry note at, let's say, 4 or 5%. That could make your listing really appealing as opposed to a home across the street. If the exact same home is across the street and somebody can only get a mortgage on that at 6 or 7%, your seller carry note at, let's say, 4 or 5% might be really appealing. Now, if you want a seller carry note at 8 or 10%, maybe not as appealing. So seller carry is a really good variable that you can really control. What is that financing piece going to look like for the buyer, and use that to your advantage. Even though there's a lot of inventory on the market, not everybody could qualify for what you can choose to offer on a seller carry note. Would you agree with that, Nick?
Yeah, I would agree. I think it can be very attractive for a buyer, but the buyer is going to be wanting to get the best rate possible. So if you're going to seller carry your note back at, your buyer's not going to want to borrow at 8 to 10%, right? But that's where it really makes sense as a seller, because why would you turn around and try to lender carry it back at about 4 to 5%? You can come to Ironton Capital and we'll double your income if you want to do that. We can bring in on an income fund at about 8 to 10%. So I think it's very good for a buyer, but I think it's more challenging to come to a reasonable agreement with between the buyer and the seller on a seller carry, especially in residential.
Yeah. And there's a good question here from Roxy. With so many people in the government being laid off, do I think a lot of homes will hit the market? My answer to that is no. And the latest stats that I saw is the projection, and this changes rapidly. So I may be wrong, but the projection is roughly 50,000 people will be cut from the federal workforce. Now, 50,000 people, while that is a large number, if we were to have 50,000 homes come on the market tomorrow, and remember, this is nationwide, not in Denver, I think that would move the needle maybe 1/4 to 1/2 of a month of inventory. So I don't see that if if all 50,000 of those homes came on the market tomorrow, is that going to lead to a buyer's market and more inventory than we have buyers? No, I don't think so. And I think we have a chart later on that's going to talk about inventory levels nationwide. So we might have some more details for that. That's a really great question. And we'll see if we have a chart that'll help answer that.
Yeah, to dig into that a little bit more, Roxy, I agree with Joe there. This is a very hyper local question that I do think will more impact the DC market than any other market in the United States. And we've kind of already seen what's happening in the DC market. I don't think we may have some of that data, but we are seeing quite a bit of inventory popping up in DC because a lot of those federal employees that are now getting laid off. But to generalize that nationwide and say that Denver will have that same effect, I think is very unlikely.
I agree. So let's keep going. Consumer confidence. All right. And we're going to start getting to some of our charts here. Consumer expectations have soured after extensive tariff discussions in the media have raised the expectation of inflation. And so you see here on the left that the consumer sentiment is actually declining. And when this number is going down on the left-hand chart, that means people are not as excited about making big purchases like washer and dryers, cars, and relevant for us on this phone call, homes. So consumer sentiment is sliding downwards. And the number of people expecting to buy a home also dropped in December. Now, part of this is mortgage interest rates. And you can see home purchase intentions really kind of fell off a cliff on that slide on the left. So a lot of people are saying, hey, I maybe want to wait. And so back to what we spoke about earlier, if so many people think that it's time to wait, why are Nick and Lon and myself encouraging buyers to buy? The reason being is there's opportunity. There's a lot of people sitting on the sidelines right now, and I'm seeing buyers get really, really good deals. I'll give you just a quick anecdote. Nick, I saw a transaction that closed on Wednesday, and it was an $875,000 purchase, and the buyer got $55,000 in seller concessions that we were able to buy down their interest rate into the low fives. So the seller was willing to concede $55,000, which was, I think, 6% of the sales price in order to help the buyer get preferred financing. So those types of deals are out there. And that's what you see when there's a lot of people sitting on the sidelines. Sellers still want to sell, and there's an opportunity for buyers to take advantage of that. Other important points, inflation. Inflation worries a lot of people. And so that is a big, scary number that we're seeing. Inflation expectations are likely to increase in the near future. Now, another interesting one is the number of potential movers has increased from 13 to 18% of the population. However, an increasing number of potential movers would prefer to rent. So look at the slide on the right-hand side. As much as 36% of people, if they have to move in the next 12 months, they say that they would prefer to rent rather than buying a home. And this is the highest that it's been in the last 15 years. The reason for that is affordability that we spoke about earlier. Interest rates are up, prices are up, insurance is up, taxes are up, HOAs are up. People look at it and say, maybe I just want to continue to rent. I can see how that happens based on your monthly budget, but we talk a lot about that monthly payment for principal and interest. A portion of that is going towards your principal, which is back into your own bank account. And so as real estate agents on the call, it's important to make sure we're really educating people on that and helping them understand, if you choose to rent, hey, that's okay, we get it, but you are going to be paying down somebody else's mortgage rather than your own mortgage. Let's see. Somebody had, if you have, share an anecdote of an owner carry when selling. I do not have any stories about that because I would not be involved in an owner carry transaction because everything I do, they would be getting a new loan. But Nick, let me ask you, do you have any stories about a seller using an owner carry?
Not so much in residential. I mean, we see a lot more in commercial. We've invested in a lot of deals where as a mom and pop owner, and they've owned the property for, 20 plus unit apartment complex for decades. It's free and clear, and they can easily turn around and lend it back. Basically be the lender, be the bank for the seller. So I've only seen it in commercial. It's actually come up quite often as a result of this high interest rate environment that we're in. So like I said, very common in the last 2 years in commercial, but I have not personally seen it from a residential standpoint.
Yep. And Nancy asked, do we have any stats of U.S. buyers choosing to buy and move overseas? The answer to that is no, we don't have that. So I would not be able to give you an educated answer on what percentage of the population that is. Now, here's another one we touched on. This is the number of sales over the last 6 years nationwide. So we really peaked in 2021 with nearly 7 million home transactions. And then we've seen a steady decline. And last year, this slide is a little bit outdated. This was a projection that we thought that last year would be 4.6 million homes. it actually ended up being 4.03 million homes. So it's the lowest number of home sale transactions since 1995. So nearly a 30-year history. And last year was the lowest in nearly 30 years. So if you're a real estate agent and you said, man, last year was a tough year, I didn't sell as many homes or help as many buyers as I would have liked, this is the reason why. There was just a lot fewer transactions than we've been accustomed to in recent years. And then this ties in, we do expect that to increase anywhere from 5 to 15% nationwide this year. Let's see. Now, Roxy did mention that she did an owner carry on a house that she sold, and she wanted the monthly income at the time. So I think that's a great point. You know, owner carry, if you're looking for that monthly income, can be a great way to do that. You know, something I would encourage you to weigh is, let's say I'm going to sell the house today and I'm going to get $300,000 in proceeds. Would I be better off taking that $300,000 and investing a portion of that with Ironton Capital, whether in the long term, the short term, or the medium term fund? Or am I better off leaving that equity in the property and collecting interest at 5, 6, or 7%? And Nick, if I wanted to do an owner carry, that's something that I could call you and you would help me walk through that analysis. Is that right?
Not necessarily on an owner carry. We don't.
But I mean, an owner carry as compared to what if I sold and invested the money with Ironton?
Yeah. If you're considering selling, we can do an analysis. If you took the proceeds, put it into an income fund, where would you be in 5 to 10 years from an equity growth standpoint? Same with the long-term fund. And then you can compare that to where you would be if you did an owner carry on your rental property post sale of whatever that property may be. So yeah, we can do that. If you want to reach out, we're happy to do that with you.
Yep.
Seller becomes a landlord. Somebody write owner carry, then the seller becomes a landlord / property manager. How about a lease option for the buyer? So CJ, in an owner carry, you're selling it, and then you're essentially the bank. You're the lender, and you want to be in the first lien position. You don't want to have them go to a bank and then lend and be in a second lien position, because that puts your debt at more risk. So you want to be in the first lien position where you're the bank. So you should have. I mean, you're a debt. You know, you're in a debt position, so you've got no landlord responsibility, you have no property management responsibility. You know, so the good thing is that if they foreclose or go into default, you can buy the property right back if you're in that position. Hopefully, it doesn't get to that point, but that would be the benefit. And a lease option, that's an option. Yeah, you'll definitely want to speak with an attorney regarding that.
Yep, that's exactly right. So let's keep moving on here. So the next one we see here is buyer traffic at new homes is really, really low. And this is all about new construction, not resale homes. But you see that red dot on the right-hand side, new homes are getting, a third of the number of showings that they were getting back during the COVID years, or what we like to call the unicorn years. You've really seen that fall off a cliff. It looks a little bit like a chainsaw pattern here because of seasonality, but it is lower right now than it has been any time in the last 10 years. So definitely something to consider if you're looking at new homes or you have buyers looking at new homes. There might be opportunities working with those builder sellers. All right. So many renters are struggling, which is part of this pessimistic consumer confidence. And you can see here, 25% of renters had at least one bill that did not get paid last month. Homeowners, very, very low. Only about 11% had at least one bill not paid last month. And then this is kind of leading the witness. Look at this red line right in the middle where it says rent or mortgage. Homeowners had less than 1% of mortgage payments fall behind. So a leading indicator for foreclosures is delinquencies. And you'll see that delinquencies are historically low right now. So anybody that's hoping for a foreclosure wave and a foreclosure boom to bring more inventory to the market, we are not going to see that. And this is just a snippet of that. And again, we touched on this. Renter surveys show that very few renters will be buying in the near future. Now, this is one that I want to pause and look at for a little bit. Credit card payments. All right. Credit cards are making it really difficult for some consumers to save up a down payment. And what you see on the far right-hand side, consumer debt is now eclipsed $1 billion. And this is actually outdated by about 6 months. It's actually increased to $1.2 billion of credit card debt in the United States. Now, this is something that will eventually lead to some homeowners having to take out second mortgages or refinance or sell. So this is a metric that can be a little bit scary when you see credit card debt increasing so rapidly. But for all of us on the call, I think it's going to present opportunities for folks to refinance, consolidate debt, and or sell in order to get out from some of this credit card debt. And that's going to loosen up the golden handcuffs or the lock-in effect that a lot of homeowners have an interest rate of 2, 3, 4%. And they're saying, I'm never going to sell because I have such a great rate on my mortgage. Well, eventually this credit card debt is all going to come home to roost, and they're going to have to make some changes in order to continue living that same lifestyle. Now, a couple questions that I've seen pop up here. 1031.
I think the credit card debt, I think you were off by a letter. I think it's over 1 trillion now.
Oh, excuse me. You're right. It is 1.2 trillion. Yes, thank you. Which is such a big number. I often get that wrong.
Yeah, it's hard to really comprehend a number that large. Derek said, what caused the credit card debt spike in 2009-ish? Go ahead, Joe.
That would have been right around the foreclosure crisis, right? And a lot of people were taking out credit card debt in order to try and make their mortgage payment. And it sounds crazy to think about that, taking cash advance and then paying your mortgage. But a lot of people did that. They were not able to keep up with it. And that's a big part of what led to this spike right there in the middle of the slide.
Yep.
So really good question. Now, one last thing we want to talk about on owning versus renting. And again, I know everybody on this call is likely an experienced agent or an experienced real estate investor, but this is a really important slide to share with your buyers. The average net worth of a renter in 2010 was $5,400, which is that bottom green line on the far left. Over the following 10 years, the average renter net worth doubled to $10,400. So if you say, hey, my net worth doubled in 10 years, that's pretty good. But look at the average net worth of a homeowner, which is the blue line. The average net worth of a homeowner in 2010 was $187,000. And in 2022, nearly $400,000. So they had that same doubling of their net worth. But Nick, let me ask you, if you had $5,000, would you be happy if that doubled to $10,000? Or if you had $200,000, would you be a lot happier if that doubled to $400,000?
The latter. Absolutely.
I agree. Yeah, I agree. And so this is something to share with renters. And this is also something to share with property investors. Owning property over the long term adds a lot to your net worth, whether you're renting it, or whether you're living in it or renting it to someone else to live in. And most Americans still pick real estate as the best long-term investment. We've had this slide for a couple of years, and I get a little tickled now that over on the far right, cryptocurrency, 3% of people think that that is now the best long-term investment. I tend to disagree. I'm more on the left-hand side with the 36% of Americans that think that real estate is the best long-term investment. But Nick, what do you think? Which of these is the best long-term investment?
I think real estate in the long run, it's usually a very good hedge against inflation. It's more stable. And I'll always continue to support the trend. I don't think it'll ever go away that somebody's always going to want to live under a roof. And so I don't think that'll ever go away. You know, cryptocurrency, I think it can appear like anything, you see somebody that does really well and you assume that that is everybody, right? But, you know, there's very few people that got very wealthy off crypto. So if you're looking for volatility and a lot of emotional distress, then crypto is your answer. But if you're looking for more wealth, steady wealth growth over a long time horizon, real estate's usually the winner.
I think you're exactly right. All right, so let's get on to, are prices going to drop? So this slide is a very busy slide. This is one we added about 3 months ago, and I really like it. So on the left-hand side, you've got expected year-over-year home price appreciation. And then on the bottom, you've got the months of supply. And so let's look at Cape Coral, Florida in the far right-hand side. So what you have is nearly 11 months of inventory. And what happened to their home prices over the prior year? Home prices went down nearly 6%. And then let's look at Cincinnati, Ohio in the top left. You had less than 3 months of supply, and their home prices went up a little greater than 10%. So there is an almost direct correlation to the months of inventory and what type of appreciation are you going to see over a 12-month period. And we've got a box around it. Right in the middle is Denver. And, there's always various ways that you can slice and dice months of inventory. So in November of last year, according to this chart, we had about 4.5 months of inventory. And that I believe was just Denver proper, not the entire Denver metro area. So we had a little bit of a glut of inventory in the middle of November of last year. But what you saw over the prior 12 months is home prices in Denver appreciated roughly 2%. So this is a great metric that you can look at. How much inventory is on the market? What are the months of inventory? And what do we expect to see for home prices over the coming 12 months? And so I think Denver is going to continue to be in that somewhere between 3 to 5 months of inventory, showing that appreciation will be somewhere between 2 and 5%. What do you think, Nick? Do you agree with that?
I agree with that. Whenever we're doing a lot of analyses with investors, I usually forecast about 2 to 3% appreciation. If it's any better than that, then great. Your numbers are going to look a lot better. But I think with how unaffordable the market's become, I think Denver, these drawn out permit process are making it more challenging with tariffs increasing. I think that we're going to be in a more unaffordable market, and therefore I don't think we're going to see 5 to 6 historical annual appreciation again, at least in Denver.
I agree.
CJ said Florida has a problem with insurance and property tax and HOA fees. Certainly. Florida is becoming a hard market. California is another one. Insurance is definitely wrecking a lot of opportunities in those markets.
Yeah, I know we have people on the call from all across the country, but I will selfishly say I'm happy that I live in Denver and we don't have any natural disasters here. We have some fires in the foothills, but thank goodness we don't have natural disasters because that does help with our homeowners insurance. And CJ, I agree. Denver is great. All right. Now let's talk a little bit about home price appreciation. So over the last 30 years, what does this go back to? This goes back to 1991. Yep. So over the last, 34 years, Colorado is in the top 3 of home price appreciation. If we do have a decrease in home prices, we've had an increase of nearly 570% over the last 34 years. If home prices were to go down by 3 or 5 or even 10%, if you hold real estate for the long term, you will continue to see that homes are going to continue to appreciate over the long term. So I think Denver's a great area to invest. Utah also great, Montana, but you see some of the lower ones, Illinois, New York, and then the one that blew me away, California was one of the 3 bottom. Really, really shocking that was near the bottom. Because everybody, kind of tends to think that California is a really, really hot area, but actually not as good as you might imagine compared to Colorado, Utah, and Montana. Now, another one that I really like, an investment in Colorado real estate outperformed a typical stock and bond portfolio from 1991 to 2023. And the average home appreciation was just as good. So this goes back to, let's look on the right-hand side. Stock and bond portfolio is this green line. If you would have invested $25,000 in stocks and bonds 30 years ago, you would now have approximately $300,000. If you would have bought a home anywhere in the United States and put $25,000 down, you would still have about $275,000, $280,000 of equity. But what if you would have bought that same home in Colorado with $25,000 down and held it for 30 years? You would have greater than $600,000 in equity. So buying a home is really, really good just about anywhere in the United States, but outstanding if you buy a home here in Colorado. Now, we think that somebody put California market is very sad. I would agree. It is pretty clear that California, Illinois, and New York are poised to lose more value. And some measures are showing that Colorado is likely to have slower growth, but other metrics show that we might get an increase. So I think we're going to be somewhere in the middle. And Nick, I really like what you said earlier. You know, projecting 6 to 10 appreciation is probably not realistic anymore, but 2 to 3% appreciation, plugging that into your projections in the Colorado market, I think makes a ton of sense. So I'm completely in agreement with you there.
And I think that's good, right? That's
Mm-hmm.
good, right? We don't want this crazy appreciation. We don't want a market to be incredibly unaffordable. We want there to be opportunity and have steady growth, right? So the 6 to 10 appreciation won't really help the first-time home buyers coming up into the market who want to start families and buy bigger homes. We need to make sure there's affordability in the market so that we can have a healthy and steady growth of the economy and the real estate market here.
Yep. So I see a question. Let's pause on that for just a moment. Let me get to these next couple slides. And then, Nick, I'd love for you to answer that question, because this slide really goes with exactly what you just said. Affordability is hurting the number of first-time buyers. And you're seeing that on the far right, that light-colored blue bar. First-time buyers were a record low in 2024. So first-time home buyers accounted for less than 25% of the market. And traditionally, you see it's as much as 30, 35, 40, even 50% in some years. So that was a record low of first-time home buyers. And I do agree with this chart. It is all due to affordability. So let's go ahead and get to, will there be a foreclosure boom? But let's pause. Nick, can you answer Shane's question? Is there a minimum amount for your investment funds?
Yeah, Shane, we like to see 50,000. But if you'll, we'll also accommodate 25,000 if that's your preference. And yes, CJ, this will kind of help answer both your question and Shane's. You have to be an accredited investor. So you have to have $1 million of net worth, excluding your primary residence. Or if you don't meet that threshold, you can meet the income threshold, which is $200,000 or more as a single household income, or $300,000 or more as a dual household income. And you only have to meet one of those three. So if you meet one of those three, you are an accredited investor and you can invest with Ironton Capital.
Yep. Very good. Thank you. All right. Are we going to have a foreclosure boom? So looking at this slide, look at the peak in 2009 of nearly 9% delinquencies. What came immediately following that? A huge foreclosure boom. Now go to the far right-hand side of this chart. There is less than 1% of mortgages that are delinquent right now. So are we going to see a foreclosure boom? Exactly what CJ said. No, we are not going to see a foreclosure boom, because this is a leading indicator. We would need to see a really big spike in delinquencies before there would be a foreclosure boom. So not going to happen. And another important point, homeowners are sitting on a record amount of equity. There's more equity in the United States right now than there has ever been. And if you look at the left-hand side of this chart, the United States was actually upside down with equity versus debt after the global financial crisis and the 2008 and 9 foreclosure boom. Are we in position that that's going to happen again? No, there is record number of equity. And then on the green pie chart, nearly 40% of homes are owned free and clear. So if you're counting on a foreclosure boom for your investment strategy, more than 40% of homes cannot even possibly go into foreclosure. So no, you're not going to see a foreclosure boom. And the number of mortgage-free homes is increasing. If we look back at 2010, was less than 33% of homes that had no mortgage, and now it's greater than 40% of homes. So people have gotten more conservative in their home financing, which I think is a good thing, but maybe a bad thing if you're an investor hoping for a foreclosure boom, because it's not likely to happen.
Now, on that chart, do you see, or do you find that, are these people trading out of a home with a ton of equity into maybe they're downsizing into another house where they can buy all cash, or are they coming with all cash right out of the bank account to buy a house? What do you often find is that is the most common scenario there?
So that's a little tough for me to answer, because I don't actually deal with cash buyers. The only folks that work with me are obviously getting a loan. But what I hear through conversations with real estate agents, it's about 50-50. 50% of the time, it's someone selling a home in Seattle, Washington, or Los Angeles. They're selling that home for, $1 million or $1.5 million. maybe it's got a $500,000 mortgage on it. Then they're coming here and they've got $1 million or $500,000 in cash, and they're just using that to buy a property. So I hear that's about 50% of the time. The other portion I hear is, hey, we've got a home, but we've saved up $500,000, $700,000, $800,000. We're going to pay this, buy this new property in cash, and then sell that prior home and replenish our cash reserves. So I hear about 50-50, but that is just through my conversations. It's not any actual data because I don't deal with cash buyers. Oops.
Makes sense. That's such a high number. 40% is just such a high number for those who own free and clear. So
yeah, it really is. Now, are mortgage rates going to go up and down? So Nick, I'll let you handle all of this. This is right up your wheel. No, I'm just kidding.
The crystal ball.
So mortgage rates have been increasing. However, there's been some slight improvements over the last 2 weeks. If you look at the top chart, we see that when we put this together a couple weeks ago, interest rates were greater than 7%. They're now just below 7%. The average is right at 6.89%. And you do see that the 10-year Treasury has begun to improve over the last couple of weeks, and that is one of the benchmarks for 30-year fixed rate mortgages. And we are seeing those Treasury yields improve, which is leading to improved mortgage interest rates. Will that continue? I hope so, but I don't really think that that's going to continue over the long term. And these are the predictions. So right now, as of third quarter, rates were right around that 6.5%. And there was predictions for rates to go up through the fourth quarter. That did occur. And now we're here kind of where this blue and green line are intersecting. And Fannie Mae, the Mortgage Bankers Association, and Wells Fargo are all predicting that interest rates are going to get down to the low sixes by the end of the year. I'm a little more pessimistic than that. I think, if rates get to 6.5%, we should all be really, really happy, and we should get buyers off of the fence. If we were to get to 6.25%, I would be thrilled, but I don't see the fundamental economics that are going to get interest rates quite that low. And interestingly, interest rates are still historically very attractive. All right. Now, I understand through the 2010s, the average interest rate was 4%, currently anywhere from 6.5 to 6.8 to 7%. But the average over the last 50 years has been 7.7%. And if you think back, Nick, when did your parents buy their home? Did they buy their home in the 80s or 90s, I would guess?
90s, I believe. Yeah.
Yeah. And have they gained a ton of equity, and that home has built a lot of their net worth?
Yeah. And then they moved out here, and they got, they moved out here last year. And so they sat on it for about 25 years. And, that was the result.
And even though when they bought that, average interest rates were 8, maybe 9, maybe even 10% in the 80s and 90s, they still made a ton of money on that property. And that's the point of this slide is while interest rates have increased, it's still historically very attractive, and buying a home and keeping it for the long term is still really, really beneficial to most folks. Now, mortgage interest rates are actually less relevant than a few years ago because of what we touched on a few slides ago. There's a record number of people paying with cash. So among the buyers that borrow, the size of the down payments are also going down, probably because of higher home prices. So the people that are borrowing more, but there's more people paying with cash. As of about a year ago, greater than 34% of all transactions were paid for in cash. Now, this is one of my favorites, kind of back to what I was just asking you a moment ago, Nick. In 1971, the interest rate for a mortgage was 7.3%. If you were a buyer and you said, I'm going to wait for rates to go down, you would not have purchased a home until 1993. It would have been 22 years that you would have rented waiting for interest rates to go down. Meanwhile, the value of real estate quadrupled over that time period. All right. So think about that. If you have a buyer that says, I'm going to wait for interest rates to go down, what if it's 22 years from now, even at 2 or 3% appreciation, home prices are going to double, triple, maybe even quadruple. And that home buyer is going to miss out on potentially 22 years of equity growth. So I love this quote. Don't wait to buy real estate. Buy real estate and wait. I think that's a really, really important one for all of our clients that we're counseling. Now, do increasing interest rates impact the market? So increasing mortgage rates predict lower sales volume. And that's exactly what we've seen. This black and blue line on the left-hand side, you see that mortgage interest rates were increasing. And what did that do? That decreased home sales, right? So the blue line is an inverted chart. So as mortgage interest rates went up, that blue line goes down. And what happened to transactions? It stayed right in lockstep with it, and transactions went down along with increasing interest rates. So if interest rates get a little bit better, can you expect for home prices or home purchases to get a little bit better? Yes, but don't expect this blue line and this red line to suddenly go back to 2-3% interest rates, because that's not highly likely to happen.
Mm-hmm.
And this one is really interesting. Withdrawn listings. We are seeing more listings being withdrawn now than any time over the last 7 years. And I think that's just a function of not as many sellers are getting the offer that they want. So if you're counseling a seller, you really need to have them prepared to have that property priced appropriately. And don't be afraid to have price reductions if you're not getting the transaction or the showing count that you need. And homes are relatively expensive as compared to rents. This is a new chart that we have, which is the price to rent ratio. And you see that home prices are higher now than just about any time in the past as compared to rents. And this goes back to what we were talking about earlier, with some people are saying, hey, I'm just going to continue to rent because it's cheaper. Well, on a monthly basis, maybe that's true, but rent prices only go in one direction. What direction is that, Nick?
Usually up. Yeah.
That's right. That's right. Over the long term, your rent will increase, but that 30-year fixed rate mortgage is inflation protected and it will not go up. So again, counsel your buyers or your investor clients. Might still be a good time to buy a home. All right. Home sales falling through. We saw 16% of homes fall through in December, so just 2 months ago, which is the highest rate on record. All right. This shows that buyer affordability challenges and tighter financing conditions are leading to more fussy buyers. So if you're representing a seller and you get that home under contract and that buyer comes back with a laundry list of items on inspection, counsel your seller to fix those items. Because if that transaction falls through, which is happening at record pace, they may have a really difficult time finding the next buyer. So if you get a fussy buyer, be happy that you've got one. Do whatever it is they're asking in order to get that transaction to the closing. Because if it falls out, you're going to have a really hard time getting another buyer for that property right now. Now, this one we touched on, the number of closed deals has gone down significantly. And we ended last year with a total of 4.03 million home sales. So the way I like to describe this chart, this big spike that we had during the COVID or the unicorn years, those were kind of like a big paycheck advance, right? What did we do? Interest rates went really, really low in order to stimulate the economy, in order to get people to buy homes and create transactions. And it worked. But when you fast forward a lot of people into just a couple of years, it takes a while for that backlog of people that fast forwarded to catch up. So I think of this as a paycheck advance, that everybody got really big paycheck advances, everybody in real estate during 2020 and 2021. And now we're going to have a couple of slower years while some of those buyers who fast forwarded have already transacted. So don't be surprised if you see that this year is another tight year for the number of transactions. And then what you see here, the number of applications for a new mortgage is lower than it has been in the last 10 years. And that's what you see on the far right-hand side, that dark blue line. That is the number of mortgage applications, which is lower than it has been in any year of the last 10 years. All right, so let's keep going here. Number of showings. This is a really important one. This pink dot on the left-hand side, showings are at the lowest level that we've seen since 2017. So this is really important to counsel your sellers where they're selling, whether they're an investor seller or an owner-occupant seller. Every showing really matters. Every showing is critically important because you're not going to get as many this year as you have in past years. Even compared to 2024, we're starting off with 2 less showings per month per property as compared to last year. Now we're getting close to time that we've got to wrap up. If you have questions, make sure you're putting those in. I'm doing a lot of the talking here, but we want to make sure that we touch on any questions or comments before the 7 o'clock hour. So Insurance costs, we've spoken about this. Average insurance losses from hail. Colorado is actually leading the nation in hail. Magdalena asked, are we sending the slides? Yes, you're going to get an email after this is finished with the slides. And people are staying in their homes for much longer than they used to, which might be reversing. But we are seeing the average tenure that people are staying in their home is nearly 10 years now. All right. And let's move on to short and long-term rentals. Nick, do you want to touch on this? You're really an expert on the distribution of rental housing. Give us some commentary on this if you don't mind.
Yeah, so you can, some of this is a little bit self-explanatory, but you can see what makes up most of the rental housing according since 2020. So you got 50 plus unit apartment complexes that make up most of it. And then you've got the 2 to 4 units. So you've got the small multifamily space. And then 5 to 24, you start approaching the large multifamily, technically, which starts at 5. But at the end of the day, you've got 1 unit, your single family rental. This is the bulk of the type of rental housing that is out there on the market right now. And so I think that the single family rental side of things, there's a lot of legislation changing in Denver that's making it harder to be a landlord, but nationwide, I think as the market becomes more and more unaffordable, Joe, you might have some insight into this, but the average first-time homebuyer age is probably above 35 years old at this point in time, which means
that's right.
People are going to want to rent houses, right? They're going to want to rent houses with a yard, with a fence, so they can let their dog out in. They don't want a neighbor above them and to the left and right of them and beneath them. So I think that the single-family rental market will be in huge demand, continue to be in huge demand for that exact reason. But this just shows you, here's the breakdown of the multifamily side of things and how the total unit count is spread across each category here.
Yep, I completely agree with you. And then what you see here is that rents are growing faster than income in most cities, and Denver's kind of right in the middle. As we've touched on a few times, we're still a pretty positive housing market. We are not like a Washington, D.C. or a Los Angeles where you're seeing a lot of challenges. So we're right in the middle. We're not seeing any massive swings one direction or the other, which is one thing that I really like about the Denver market. And the share of financially stretched renters is right in the middle for the United States. New Zealand has a ton of people that are spending more than 40% of their disposable income on rent. Australia, really, really low. And we are right in the middle. And then the number of households that are renting as compared to other countries, again, we are right in the middle, which I think is positive from a global standpoint. We have a full presentation that we do on long-term rental laws from 2023 and 2024. So we're not going to dive into that today. The big thing I will tell you, if you have rental properties, make sure you know and understand these laws. And if you don't know and understand these laws, hire a really great property manager. And we have some great resources for you on that. All right. And short-term rentals, I think these are going to soften a little bit. And we've got a couple of slides here that talk about that. And what we're seeing is short-term rentals, there's kind of a glut of supply. I actually looked at a short-term Airbnb for a trip that I'm going to be taking to Utah later this year. And Nick, this will blow you away. 5-bedroom house, 3-minute walk to a large reservoir with recreational opportunities, 20-minute drive to Zion's National Park on a holiday weekend, 5-bedroom house. Take a guess how much per night?
$600.
$277.
That's incredible. And I assume you would attribute that to the hyper supply that we're seeing in the short-term rental market, which I'm sure is localized. Each market has, a certain amount of supply, but that must be the case. You must have a load of supply that's causing that to drive down, right?
That's exactly what it is. Yep, that's exactly what it is. So I would have thought exactly like you, $600 when I was searching around, and they were all like, this was the highest priced one. It was the biggest house. Everything else was 150, 190, 210. Yeah. So it was the biggest house. So it made sense. It was the highest price, but very, very surprising to me.
Yeah, that's amazing.
Yeah. So if you have short-term rentals, just make sure you're monitoring, that average revenue per room night, because that can really drive your occupancy down if it is overpriced. All right, keeping going here. Let's touch on any of our final slides. Apartment updates. We're seeing absorption continue to go in apartments. Any major things you want to touch on here in apartments, Nick?
I think that what's important, if we look at the last couple of years, what's happened, 2020, 2021, when we hit historically low interest rates, you can go get a loan from Fannie Mae and Freddie Mac on a 100-unit apartment building at 3.25%. And so it's really easy to overpay for apartment buildings in 2020 and in 2021. And now here we are 3-4 years later, and it's just a completely different scenario. But what happened also in 2020, 2021 is a lot of new construction started, right? And so now we came into 2023 and 2024 with a lot of supply. So we are in an oversupply market. That's kind of the case nationwide. You see it a lot in Denver. You see it a lot across some of the largest metro MSAs in the United States. But what we also saw is interest rates really started to rise in the late half of 2022, 2023, and 2024. When we had all this new supply get delivered, we also saw nearly a 60 to 70% reduction in new starts. So I think what we'll see in 2 to 3 years, we've seen a lot of decline in some markets. Austin's kind of led the charge as far as rent decline. We've seen a little bit of that in Denver as well. But what we will likely see is I think that will normalize in the next 2 to 3 years because we've had such a large reduction in new construction starts. Some of the things that have caused that, everything that we've mentioned on this call, high interest rates, insurance costs, the permitting process in Denver. It's not just Denver, it's other markets where, it can take a long time to get permits through the horizontal development phase. But I think we'll see a normalization in the next 2 to 3 years as supply is limited again. So that's just, some of the things I wanted to mention. We have a lot of dry capital out there, dry powder and liquid capital out there ready to take advantage of a lot of these opportunities that we're seeing as well in commercial, especially with the loans that are resetting from 3.25% to 6.25%. So that's wiping out a lot of equity. So I don't want to say we're seeing somewhat, in 2008, 2009 happening in the commercial market. I don't think it'll get to that point because there's so much capital and liquidity that'll be ready to take advantage of those high value purchasing opportunities. But there's a lot of, what we saw in 08, 09, and 09 that led to a lot of that. It was the adjustable rate mortgages, right? And there's a lot of that. That's the commercial real estate market right there. We're buying a lot of these on 3 to 5 year notes that are adjustable rate mortgages. And for those that bought many years ago, their time is up and they're either going to have to, fire sale or refinance and bring in more capital. So if you ever want to talk about the market from a multifamily standpoint, feel free to reach out to us. We won't dive too much into it on this one.
Yeah. Well, that is our time for the evening. I'm really grateful for all of you that joined us. Let's get to our final slide here. Nick, if we want to learn more about Ironton Capital, we want to talk about, ways that we can get out of some of our properties. I'm tired of being a landlord and I want to sell some of my properties. How can you help us redeploy that capital?
Yeah, guys. So you can go to irontoncapital.com/more listings YC. You can schedule a call with us. You'll be able to go through that link, schedule a call with us. And if you're evaluating, if you want to sell your property this year or next year, we can help build a business case around that, show you the numbers and some side-by-side comparisons of where you can redeploy that equity. If that sounds interesting to you, feel free to go to this link and schedule a time with us.
Yeah. And my name is Joe Massey with Castle and Cook Mortgage. And how I fit with the Ironton Capital team is maybe you decide you want to keep that property. You say, hey, I've gone through this and I want to invest $100,000 or $200,000 with Ironton Capital, but I still really like owning this property because it's an appreciating asset. Nick and I can go through an analysis with you to show you how you can take cash out of that property in the form of a cash out refinance, or perhaps a home equity line of credit or a fixed rate second mortgage. You retain that rental property. I'll give you a new loan to give you some cash. You invest that over there with Nick and the team at Ironton Capital. And we can show you all the different ways that you can slice and dice that equity and potentially improve your returns, or maybe sell that property and just make your life a little bit easier. So I put my notes into the contact or into the chat, so you guys can call me, email me. Would love to chat. And if anybody else has any other questions, please feel free to reach out to us. And you will get an email after this with all of the slides. And Nick, thank you as always for being my
Thanks,
partner
Joe.
on this. Always enjoy working with you on these.
Likewise, Joe. Thanks for being here, and everybody else, thanks for taking your time this evening to join us. So take care.
See you guys.